Welcome to Changing World, New Opportunities. This podcast is brought to you by the DC Investment Forum and hosted by me, Louise Fernando, and my co-host, Dave Whitehair.
This season, we're talking to the UK's leading master trusts. Millions of members and people in the UK now rely on master trusts for the future of their retirement finances. And we were interested to know how master trusts are investing and what the future holds.
In an uncertain world, how are they managing risk? And what's next on their agendas?
The DCIF's mission as a whole is to shine a spotlight on topical DC investment issues. And you can learn more about our research, follow us on LinkedIn, and subscribe to the show at dcif.co.uk.
Hello and welcome to Changing World, New Opportunities. I'm Louise Fernando. I'm here with my co-host David Whitehair and with Liz Fernando. Hi, Liz.
Good morning. Well, good afternoon. Something. Hello.
I suppose it depends on what time they're all listening and watching.
Yeah.
Liz is Chief Investment Officer of Nest. And you have been at Nest since, I think, May 2023. Is that right? So last time we spoke, you were quite new.
So I've been at Nest for about 5 years now.
Oh, okay.
But I've been CIO.
CIO, that's right, of course.
May. Yeah, May
it's going
23.
Well, but yeah, last time we spoke, I think you were new to the role of CIO.
Yes.
And I've written a few things actually about what you were up to then. So you were about to start investing in timber, so I'm interested to hear about that. And also, I think we talked a little bit about the constant assets flowing into Nest and that pressure of, finding someone to invest them and working that whole issue out. So excited to talk a bit about that. And you talked about net zero, and like we're talking to everyone about it. Interesting to hear how you're getting on there.
Yeah, I mean, Nest has obviously been at the cutting edge of DC kind of investment innovation since its foundation, really. So the constant stream of exciting announcements with what you're doing on your investment portfolio. So really looking forward to having this conversation and seeing what's the latest.
So when we spoke 2 years ago, you kind of gave us a bit of a helicopter view on how you're invested, but it might be helpful just to bring everyone up to date on where you are today, if that's all right, and anything exciting and new that's going on.
Yeah, absolutely. So I think the big change we made 3 years ago was to say people investing with Nest think we're going to provide them with an income in retirement. So when they hear the word pension, they assume they're going to get an income in retirement from us.
Yeah.
And so we pivoted our investment objectives for the default strategy to be delivering the best retirement income for as many as possible. To recognise the fact that it's more than pot size at retirement that people think we are doing for them.
Yeah.
So obviously pot size at retirement's the key driver of that.
Yeah.
But that's not the end objective. And alongside that, we changed the way that we invest. So we recognise that people are way more complicated than having one goal and one definition of risk at any one time. So we now blend 5 portfolios with very different objectives and very different definitions of risk in different proportions depending on where someone is on that savings journey towards retirement.
Yeah.
And we got rid of reference portfolios and SAAs as part of that exercise. So we now use a form of total portfolio approach, which has been really liberating for the team because it means you only put ingredients into your portfolio if it improves the probability of meeting the objectives of that portfolio.
Right.
So it puts you much more in contact with current market pricing and market conditions, but still allows you to be long-term in your thinking. And that's a really interesting combination. Gets rid of the anchoring problem of you have a neutral weight in a SAA or a reference portfolio, and people are very reluctant to move very far from that.
Yeah.
Whereas you take away that constraint and you're suddenly free to make really quite smart decisions, which, is... as an investment team, as I say, is really, really liberating.
Amazing.
Has that had an impact on some of the timing of your allocations? If you talk about current market kind of pricing and valuations?
I wouldn't say it's just made us more market aware.
Right.
So, for example, one of our portfolios has an income-seeking objective, and we're looking for a minimum yield on that portfolio of 2.5%, which is broadly 2/3 or so of the wage in retirement we think we can sustainably deliver people. The yield on developed market equities at the moment, global developed market equities, is about 1.5% on a good day. So it doesn't meet that hurdle anymore. And therefore, there's no point investing in DM equities in that income-seeking portfolio. You're much better off going to places like high-yield bonds or private credit or even timber. They generate they clear that hurdle rate much more effectively. So use the assets in the right places. DM equity still has a great role in other portfolios, just not in that one.
That's really interesting. It's now making sense why I've seen you making these allocations, and we've seen them in the kind of trade press, and it's on this basis. Could you just remind the viewers, listeners, on how that kind of glide path journey takes form at Nest? You've got a growth phase, and then you introduce these more decumulation and outcome-focused portfolios.
Yes. So we used to have a very clear 3-step process. So a foundation phase when people were very young, to get them used to the idea of saving, because at that point the worst thing people can do is to stop saving because they see the value of their pot flying around in ways they don't feel comfortable with. And then we had a growth phase, and then we had a 10-year glide into retirement. 3 years ago, as part of this whole revamp, we went for a much more smooth journey. And we unashamedly now take advantage of the fact that private market assets don't mark to market every second of every day. And therefore, they can help with that dampening of volatility in the early years. They also have really good expected returns on them. And you can show people what they're invested in. So showing someone the wind farm that they have exposure to or a building that they own, that's way more tangible to people than saying, oh, you own some bonds in your portfolio. So with younger members, we can have up to half of their portfolio in illiquid assets. And then gradually, as they move through that savings career and as they have less capacity for a liquidity risk, we run that down, put in more liquid growth assets. And then from about 55 onwards, we start thinking about that income component and the fact that people need some kind of visibility on what kind of income they could have post-retirement so they can do planning. So that component starts coming in, as I say, beyond 55 quite heavily. And then the final little component is a thing we called longevity protection. And that's the idea that as a DC saver, running out of money is a real concern for people. And so that's the very beginnings of an allocation to an insurance strategy, which really comes into its own post-retirement. But we very gradually start that right at the end of that glide path.
Okay.
Interesting. And yeah, if anyone listening or watching hasn't already listened to our podcast episode with Gareth Turner, he talks really well about the retirement blueprint. I appreciate for you that's still a work in progress, but that might, I guess, affect some of your investment strategy.
We're having a big think at the moment about how you invest post-retirement. Because, I mean, investing pre-retirement is a huge challenge. Doing it post-retirement where you need to keep people invested because they potentially are going to be with you for another 20 or 30 years. So you can't put them all into bonds and expect to give them a really good income in retirement. But you've obviously got no contributions coming in. So you've really got to worry about path of returns risk in a way that you don't pre-retirement, or at least not until quite late on in the pre-retirement journey. And so we're thinking hard about how we can manage that. And illiquid assets may play a role post-retirement as well. So if we can run through some of those pre-retirement components, those 5 building blocks, they may flow quite nicely post-retirement as well. But we're still thinking quite hard about that.
Yeah, it's quite a conundrum. Tell us a little bit about risk management and how that's evolving. I mean, I think we probably asked you a version of this question last time, as it feels as though there's never a quiet time in the global economy. Feels like we haven't really had a break since last time, and I imagine your answer might be similar or the same, but is there anything that you've evolved in your investment governance or Are you trying to keep calm and carry on?
Well, that as well.
Yeah.
But we've been on quite a journey with the investment team. So the investment team has grown.
Yeah.
We onboarded Aladdin as an investment risk system a couple of years ago now. And so that is beginning to be used in anger in how we build portfolios and try and make sure they're resilient to different conditions. The other huge change, which actually only happened yesterday, is
breaking news.
a governance shift. So we have disbanded the investment committee, which was a subcommittee of the main Nest Corporation board. And we now have an enhanced Nest Invest board, which oversees the investment management subsidiary Nest Invest.
Right.
New independent chair in Sally Bridgeland, some continuity of members between the old investment committee and new Nest Invest board. And the idea of that is it should speed up our decision-making process.
Right.
So that more decisions are delegated down to the investment executive, particularly manager selection. Now will sit with the executive rather than with investment committee. Should streamline governance, because before we had a Nest Invest board and an investment committee that required dual reporting.
Right.
So this all comes down into a single body independent chair. So yeah, really excited to see how that unfolds.
Yeah. Given what you were talking about in terms of your change over the last 3 years about moving to more of the outcome-focused approach and moving away from kind of SAA modelling, has this changed the way you think about diversification? Has it opened up more opportunity?
I think it... so diversification is one of our investment beliefs, and that still holds. We are now tolerant of having 100% risk in equity risk in the higher growth portfolio.
Right.
Because once it gets to a member level in the default strategy, no one only has the higher growth component. That's always blended with other things. We think about diversification in terms of not wanting to have all of your eggs in one basket. So I talked about these different goals. For the higher growth fund, we think that listed equity, private equity are pretty fungible. Obviously, you can't control how and when your private equity allocation grows up. But those are pretty fungible. Some bits of private credit are straying into that private equity type space. But in the other portfolios, we wouldn't want to bet everything on high yield. For example, in the income-seeking portfolio, we would like to have different sources of that income in case something goes wrong with one component and it doesn't all disappear. So from that point of view, we're thinking about diversification. I think the other beauty of moving away from leaning very heavily on SAA and optimizers is there's a huge debate going on at the moment if we're in a regime shift. And therefore historic correlations may not be a great guide to the correlations that we're actually living through now. If inflation is going to be higher and more volatile, interest rates look like they're not going to get anchored back to zero again. That's a very, very different operating environment to the one we've been in since the GFC. And most optimization models will be putting quite a lot of weight onto a period of time that's probably not what we should be looking at.
That's really interesting.
I mean, it's such an impossible question to ask about the regime shift. I'm just so interested in kind of what are you looking at to determine whether we're in a regime shift? I
mean, we're looking at different factors, but predominantly it is the economic backdrop. It is just so different to the one we were in for but in the period between the GFC and COVID, really. You know, obviously I'm exaggerating, but essentially inflation was zero, interest rates were zero, there was no term premium. Equity markets were pretty, nominal growth was okay. Not so great in Europe, but equity returns were fine. We're suddenly in an environment where inflation is pretty firmly stuck above 3%. We think inflation will be more volatile going forward as we go through the climate transition. and other supply shocks, trade wars, tariffs, anyone? And with inflation being above target, it means interest rates are going to be that much higher. If inflation is volatile, you're going to demand a risk premium for investing long horizon in gilts or fixed income assets.
Yeah.
And so it's just a super different world.
Yeah. When you frame it like that, it really does sound very different. And I guess another kind of big sort of structural challenge with Nest is just the sheer volume of assets that are coming in all the time. How are you finding that sort of 2 years on from our last conversation? How is that going?
Yeah, so we're now somewhere between 57 billion pounds of AUM. So when we last met, I was probably talking about 40 billion.
Yes,
probably.
I think so. Yeah.
So yeah, I mean, just the growth has been enormous. In some ways, volatile markets are great for us because if you have a strong long-term view on the relative value of asset classes, market volatility gives you that ability to buy low. We don't do a lot of selling, but we can turn taps off to things that we think have got overstretched. And so you can actually pick up not quite a lot. You can pick up a bit of extra return by rebalancing smartly. It's been modelled somewhere between, I've seen figures all the way from kind of 20 basis points up to 70 type basis points.
Wow.
It's all incremental return if you can do that well. And so we have been taking advantage of particularly equity volatility. We have our central target, and then we use derivatives to help us manage back to that at the appropriate times.
Right. You're well known as one of the leaders in kind of private asset investing in the UK generally, let alone in DC. How's your strategy evolved over the last couple of years in terms of what you've been allocating to, and how's that playing out? Yeah,
so the most recent addition has been Timberland. So we now have 2 managers working for us there, Campbell Global, who are part of JP Morgan, and BTG Timber Investment Group. Yeah. They have good geographic complementarity, so they shouldn't be competing head-on for assets, which is always something we're a bit nervous about. Yeah. We've got about £500 million already invested in Timberland, and ambition to grow that quite substantially. The other 2 things we've been doing is building up our internal team. So we've added quite a lot of specialist expertise over the course of this year. Had senior investment managers join us in real estate, private credit, private equity, to make sure we've got that depth of team to really hold managers to account on what they're doing for us and to be looking for new opportunities. And then our private credit strategy, we had originally planned to have quite an allocation to US mid-market loans within that. Our existing managers were really struggling to deploy at the pace that we were looking for. And with private credit, because it matures quite quickly, you're always running to get that money reinvested. And obviously our AUM's growing. So that challenge of finding the right volume of loans to make at the right underwriting standards is big. Yeah. And so we have been conducting a search for a specialist US mid-market loans manager. We do have a preferred candidate, but we're just going through final due diligence checks, so that it's not a name we're announcing yet. But that'll be another good adding some depth to that private credit portfolio.
The Timberland allocation is obviously fascinating, albeit you maybe mentioned it last time, but what was the genesis behind that allocation? Is it diversification, return profile, but also there's a climate, nature link here, or all of the above maybe?
Yes, so it is a very attractive diversifying asset. It's also a fabulous asset for a pension scheme. It's inflation linked. It broadly grows with GDP because the timber prices, as you harvest the wood, it obviously goes with the real economy. So it's quite different to other asset classes you invest in. It's very long-lived as well, which works quite nicely for young savers who are going to be, some of these trees take 80 years to get to maturity. It actually matches quite well for a
kind of a lovely metaphor
for a pension saver.
Yeah.
And then, there was a nature. We've had climate goals for a long time.
Yes.
And I think everyone is increasingly recognising that natural capital is the flip side of climate change. The two go hand in hand.
Yeah.
And so we had taken some steps in our listed equity portfolio to think about nature and natural capital in that asset class. And this was another way of thinking about that. So the due diligence we did with the managers featured very heavily on how they steward the assets, how they interact with the local communities, because it's potential for big conflict there. And so that husbanding of the resources, how they look after water courses, how they look after habitats, birds and nesting, all sorts of things you learn about when you're due diligencing timber I certainly never knew about before. No. You don't do harvesting. This is a fun fact.
All right.
When you harvest a stand of trees, it's really important you don't end up with hard straight lines. Wow. So the boundaries have to be zigzagged, because apparently deer will not cross a straight line of trees.
Wow.
And so if then, migration patterns,
right,
it really matters. So, but if the boundary is zigzag, apparently no problem.
Wow, there you go.
And where do you see timber sort of fitting within your members' life cycle, like throughout? You were saying the longer term 80-year time horizon.
Yeah, so we use it in two places. We use it in what we call long-term stable growth, which is a big component for younger members. It can be up to half of their asset allocation as youngsters. But also because of this inflation-linked income property, we also use it in the income-seeking portfolio. And so in that capacity, I could see it running post-retirement as well.
Wow. Which kind of brings us to our next question.
Yeah, so I think, where are you evolving your private asset thinking in terms of decumulation? Obviously, it's a challenge for lots of the master trusts. It's not necessarily nothing straightforward in terms of private asset investing, but it's certainly another big challenge with private asset investing and decumulation. Where do you stand on this topic?
Yeah, so I think it's an area as an industry we've got a lot of thinking to do. We've certainly got a lot of thinking to do. I think my first thought is that although we lump everything together as private assets or illiquid assets, not all of them are equally illiquid. So we talked about private credit earlier. Some bits of private credit absolutely are 10, 15-year duration loans to infrastructure assets. But that US lending book has typically got a maturity of 6 years.
Yes.
That's not so illiquid.
Yes.
And so I think there's going to be a lot more we'll need to do about thinking about what we really mean by illiquids, private markets. Can we segment people or segment assets more effectively? And for us as well, we do a lot of modelling on the natural appetite we will have inflows from younger members who have the capacity to buy the assets which the older members will need to be selling.
Yes.
And so it may be, and again, nothing, we haven't done the work yet, but if we can get comfortable that we're going to have those inflows and we can effectively cross between the two cohorts, then we may be able to have the capacity to run more illiquids post-retirement. We already allocate to real estate and infrastructure in to a small degree in our Nest Guided Retirement Fund.
Right.
So we have already put a small toe in the water there. But yeah, I think there's so much more really exciting thinking to do on this.
Is there anything kind of structurally that could change to make this easier, perhaps from a regulatory perspective? Or do you feel like all the right planks are there and it's just a case of learning how to walk along them?
I mean, I think for us, we've made the regulations work.
Yeah.
Two things you worry about with private markets.
Yeah.
One, the valuation point. and it being fair.
Yeah.
And then secondly, the risk of being a forced seller.
Right.
So if you aren't confident that you have got natural buyers and you suddenly get surprised by a wave of redemptions because people transfer out for some reason, or there's a regulation change that means that the cash flow profile isn't what we expected it to be, then that's something you need to be really alive to, because the last thing in the world you want to be is a forced seller of private assets.
Yes.
We should have all learnt the lessons from endowments during the GFC. You liquidate all the liquid assets and then you get left with 80% sitting in private assets you can't control.
We've touched upon this theme a couple of times already in relation to timberland and changes you've made in your equity portfolio, but that theme being sustainability. Where is Nest on its sustainable investment journey? Maybe specifically in regards to climate initially. Believe you've made net zero target. How do you measure your progress against that, and how is that measuring process evolving?
Yeah, so the data is getting better and better. We have a commitment to net zero. Sorry, we have an ambition to net zero in 2050. And that difference between a commitment and ambition is something the investment committee talked about quite a lot. It's an ambition because we don't think we can get there unless the rules and regulations are there to also get us there. So we won't run ahead of government. We won't expect companies to be doing things that aren't required of them. And therefore it's an ambition, not a target. We set interim targets, so a 30% reduction by 2025 compared to a 2019 baseline, and a 50% by 2030. We are well on target. In fact, I think we've already hit the 2025 target. So we're well on course to the 2050 target. We have thought about natural capital and those sorts of issues as well. So I mentioned earlier, we've made an allocation to a thematic portfolio to sit alongside our climate aware systematic fund, which has the vast majority of our equity assets. And so the idea of that thematic fund is it can invest across natural capital, climate mitigation and adaptation, which is obviously an important part of if climate transition doesn't work, and then social factors. And that's run by Lombard Odier. And we've given the manager the ability to flex between those themes as they see valuations and opportunities evolving. I think, we've just finished TCFD reporting, which is always fun. We will see how that evolves from here.
Do you feel like on the net zero journey, a few people have said to us that they feel like they've done the easy part so far and it's sort of the hardest work is still to come? Is that something you feel, or is that a bit oversimplified?
So I think, so it's definitely been, I'm going to use the word depressing.
Yeah.
The backtracking we have seen from the energy companies, and particularly the short-term mindset that seems to be going on here. And yes, government rules and regulations, carbon pricing isn't moving at the pace that one might like it to be, such that it would actually force that behaviour more quickly. But yeah, for companies to be backtracking on their investment spend in green technologies, to not put those changes in strategy, having put the original change where they said they were going to do this, they put that to a shareholder vote, to then not put the backtrack to a shareholder vote is really, just really annoying. I mean, it's like, that's not how. And absolutely, the board and the management are there to run the company, but they are agents acting on our behalf as shareholders, and that gets forgotten sometimes. So key strategy changes, I think, should always be put to shareholders.
And it makes it very hard, that lack of clarity for you as long-term investors.
Yes, and we do very firmly believe that you need real world change. There is no point us divesting our way to net zero because nothing changes in the real world.
Externally.
And the environment our members will be retiring into won't have changed. So we are looking for real world change. We are looking for corporates to change how they go about doing business, how the choices they make on energy sources, that kind of thing. I think whether we're getting to the hard part or we're actually getting to the crunch point where people have made commitments and now they're going to have to start delivering on them. And so we'll see who was just talking the talk and who's been walking the walk. So that could be quite an interesting thing to watch.
Yeah.
Has that had an influence on the way that your engagement is actually taking place with companies?
I think as we have grown and as our team has grown, I think we are getting more confident in our engagements because we have more resource to make sure we've done the homework so that when you go into bat with a different view to the corporate view, you're on very firm ground. We still very much expect our fund managers to be engaging with us because Yes Nest is big in a UK context, but we're not big in a global context. So if we can persuade the managers to come on board with us as well, that has a much bigger impact. The withdrawal of some asset managers from climate initiatives, that's not wholly helpful, being honest. And certainly talking to corporates, whereas before they used to get one voice or a handful of voices asking for similar things, and now they're getting a much broader set of requests and action or changes that people are looking for, grievances people have. And that makes their life more difficult as well. So it's getting a muckier landscape, I think. Instead of getting clearer, it's getting murkier.
It'll be interesting to talk again, maybe in a few years, see where everyone is by then. But in the meantime, anyway, how are regulatory shifts like the pension schemes bill influencing your investment decisions, if they are at all? I mean, I think you were doing a lot of the work anyway in the right direction, but how is it affecting you?
Yeah, it isn't really. I mean, we've always invested with our members' best interests at heart. We've always tried to look to the longer term and do what we think is the right thing for them. It's not always what they tell us they want us to do. Our members quite often will tell us they want something a bit like a bank account. And we know that isn't sensible for some, particularly for younger members. That really isn't a great way of saving for a pension. So it hasn't changed what how we think about investment or how we go about it. I think it has made us more cognizant of the fact we need to talk very loudly about the investments we make in the UK, and particularly where we make choices on the sorts of assets we will buy in the UK, where compared to the ones where we might not have a domestic bias. And then I guess the other thing that may come out of pensions bill is reserve power on mandation. We are nervous about that. We think assets should be invested in members' best financial interests over the longer term. And that needs to stay front and centre of decision making, and is always a concern that that might not be the prime motivator if you're forcing people to buy, or that you get crowding into it's a classic, too many people try and get through a small door at the same time, and all that happens is prices go up, and that isn't good for future returns.
Could you give us a couple of examples of how you're bringing those investments to life for the benefit of the membership and that kind of engagement piece?
Yeah, so you may have seen our Everyday Savers campaign. It's a fabulous piece of work that the media team have done, where we take groups of our members out to visit real assets. So the first one we did was to take a group of members who lived in and around Grimsby, and we took them on a boat out to visit a wind farm in the North Sea that they own. And we filmed their reactions to that. And we've done a couple since then, one with the Great British Bake Off winner, Candice, I forget her surname, where we got a group of members to cook banoffee pie using ingredients that are in the Nest portfolio.
That's amazing.
And the most recent one was in Poole, where we worked with Legal and General on regenerating a shopping centre, the Dolphin Centre, which had fallen into disrepair and had a lot of vacant lots. And that's been regenerated. They've given some of those units to start-up businesses on a rent-free basis for a certain period of time. And there's some great success stories have come out of that, of people being able to expand a business. A gent who had been in prison with addiction problems, and he's now set up a furniture restoring business, which is going from strength to strength. So you show people that kind of thing in their local community, and it just brings it home that that their pensions are enabling this.
This feels like the future, doesn't it? This feels like the future of our industry, and bringing the hard work that yourself and the like are doing, bringing it to life. And the UK, yes, but also globally as well, and to show people timber forests in other parts of the world, that their money is growing and the benefits that has on the environment and society as well as their portfolio. You feel like there's more of this to come.
Yeah, absolutely. And I should also give a plug for something else. We've never done advertising. So those Everyday Saver, Everyday Investor adverts, videos have predominantly been on LinkedIn. But we launched our very first adverts. Soft testing on YouTube at the moment, but we've been working with Aardman, so the Wallace and Gromit creators.
Oh wow!
So if you go onto YouTube, you can find our first couple of adverts. I'll say that again. Our media team do amazing work.
Well, Liz, let's look ahead now. What's next on your investment agenda?
Yeah, so I mean, it's never dull at Nest, that's for sure. And Gareth talked about the blueprint for post-retirement, which is, I think a really important part of this journey all DC schemes will be on. Is we've done a great job at getting people auto-enrolled, but people will start retiring and they will be looking for that income in retirement and not having to worry about running out of money or how much they can draw down in a sustainable manner. So that's one big piece of work. The other is, and I touched on this earlier, growing the internal investment team. So getting greater depth and breadth of capabilities into the internal team, so that we have that ability, say, not only to keep our existing managers held to account, but also to have eyes and ears out looking for new opportunities that fit into those building block portfolios to boost future returns for members. So those would be the two really big things on the agenda.
And in your view, Liz, what's an underrated asset class in DC?
Oh, can I have private markets as a whole?
Yes,
you can.
Because I do think they, the fact DB schemes used them so heavily tells you that they are good assets for pension schemes. The fact high net worth individuals use them quite extensively tells you people think they are a good way of growing wealth. So having them in the DC mix, you taking advantage of their different characteristics and different return streams they can generate. I think people not doing that are missing a trick.
And finally, what's one investment trend or technology you think is going to play a role in reshaping DC pensions in the next 5 years?
So it's going to be I'm sure everyone has said AI.
Yes.
I'm afraid I'm also going to, well, maybe I'll say big data. So at the moment we have we have we have a single glide path in the default strategy. I think it would be really interesting to be able to triage people based on their contribution history with Nest, based on the size of their pot they have with Nest, based on their age, so that we could send them off on different paths. Because if you're not depending on Nest for your income in retirement, and you've got a tiny pot that you accumulated over your summer holiday job as a student, and you've since gone on to other greater and better things, and you've got big pots sitting elsewhere, it's not obvious I should be investing the same way for that small pot, which someone may even have forgotten about, compared to someone who's depending on us for that income in retirement. So being able to triage people on different investment journeys so that you deliver on their different needs.
Kind of really individualised goals-based investing at its most purest form.
Yeah, I don't think we will ever get to individual with 13.5 million members, but if we can offer multiple paths and we can send people on those paths, potentially you could do some really good things. The people depending on you for that income, you invest in one way because it's really important that money's there, it's predictable, they can plan. But for someone who, as I say, may have this tiny pot they've forgotten about, if you could give them a windfall gain.
Yes.
How lovely would that be? It's like getting a premium bond prize or something in the post.
Yes, a real bonus.
And so, that's something I think would make a big difference to the industry.
We've done some work on this with DCIF. A few years ago, we did some research with Ignition House, and it's quite alarming, I think, for the industry to see. There were videos, interviews like this with people about to approach retirement, and they were asking them about their pot size and what their plans for retirement. And there were people being interviewed saying, I really need this pot of money to fund my retirement. I'm really worried about it, and it's not very big. So I've gone for the highest risk investment option to make it as big as possible because I really need it. Of course, you had a big in the audience as people in the investment world thinking, okay, well, that's maybe not what we might advise you to do, but that's the realities of, similar to what you just talked about, is understanding what cohorts of people actually wanting to achieve and what their other circumstances are.
Yeah, I mean, I guess the other big shift could be if we could see someone's consolidated finances. Because at the moment, we all only see the individual slices that are sitting with us.
Yes.
Whereas if you could see that holistic picture, you might do something different again. And so that would be, there's obviously privacy issues around that. One would need to be very careful, but and of course, not every actor is going to be acting in people's best interest, sadly. But that might be an interesting thing as well. If you could plan and invest on behalf of the aggregate rather than each individual bit.
Yes.
Oh, fascinating.
Exciting.
I'm excited for what's to come. Well, Liz, thank you so much. That's been really fascinating. Great to have an update on all the great work you're doing. And it sounds like you've got a great deal ahead still, keeping you busy.
Yeah, absolutely.
So thank you for taking the time to chat to us today.
No, absolute pleasure.
Thank you for listening to Changing World, New Opportunities, the DCIF's podcast.
Visit us online at dcif.co.uk, where you can read all our research, follow us on LinkedIn, and subscribe to the show.